training is going to be called from the beginning. It's just called the beginning, and it's financial statement basics. And I'm just going to go through a little bit about, and you may be at various levels of understanding financial statements, but it's a very important part of running your company. So this is going to be a super high level understanding, but kind of get your brain working as to what are you looking for. So, why are you in business? And these are the questions that you should be asking yourself. I can't see my own. So do you know where your business is right now? Are you profitable or are you not profitable? As we know, a lot of people start businesses, and a lot of times they just start running expenses and start running things, and they have no idea whether or not they really are profitable or what's going on. And without financial statements, it really is pretty impossible. I mean, I know you have money at the end of the month, but it's pretty impossible to know whether or not you're really truly operating effectively and you're profitable. So that's one good reason. Also, when you're in business and something comes along, are you ready to scale? Are you ready to do something different? You won't know if you don't have any kind of reports or reporting or analysis. You're not paying attention to what's happening every month. You have no idea what you're getting yourself into next. How often do you talk to, and I'm labeling it the chief financial person. And the reason I say that is because, of course, we know there's various levels of, different people that might handle your money in your company if it isn't just you. So what I mean by that is there could be a bookkeeper, there could be an accountant, there could be a CFO, a controller, there may be different people. Are all those people talking to each other as well? Because many times things become disaggregated and then no one knows what the other person's doing. And it's very difficult to create strategy if you don't know what you're looking at, and or you have someone that can help you with what you're looking at as far as your financial condition. I bring this point to, have you started your business? Is it an idea that it's time to bring to life? I know a lot of people here might be thinking about doing a business. So one of the nice things about learning through this platform is that you would have the ability to know ahead of time what you should be looking for, as opposed to having hindsight and getting all involved and say, oh, I wish I should have. It just makes things go a lot faster if you get ready to start your business, to know what you need. If you have a business that's already operating, is it efficient and effective? Are you doing things to the best of your, you won't know if you're not doing financial statements, and having someone help you or just being able to see and know what you're looking at for your financials. Do you have the proper controls in place so you aren't being raw blind? I put this little one in here because I have so many friends that have been in business before with a person that they trust. They trust them. They're doing all of it for them. And either one of two things are happening or have happened to them. It doesn't happen to everyone. And I'm not saying that there aren't trustworthy people out there, but people are either getting, money is coming out of the till, money is not being deposited into your bank account, or inventory is leaving. I had a friend who was in a car business, batteries, all kinds of other things, and batteries were walking. Nobody was doing inventory on a regular basis. It could be a feed store. It could be, any kind of items. If you aren't paying attention to checking that on a regular basis, you could be, not even realizing it. Money could be walking out of the door. I was a controller and went to an outsourced job for the city of, in the Redlands in Homestead. They had somebody who was doing the books there for 20 years. One person. No one ever audited them. Can't tell you how much money was missing. So, it starts off with little, and then it gets into something bigger. So it's very important that you, as the owner of your business, know exactly. I mean, you've heard Tony Robbins, you've heard other people that have been in these situations where, they trusted somebody and, it didn't work out well. Do you need more customers? Well, how are you going to get more customers if you don't know if you have enough money to get the new customers? And the customers you have, do you know if you're spending your money well in getting them? So that's kind of doing some marketing analysis. When was the last time you offered something new? You know, sometimes people get in the rut of doing the same thing over and over again, and they're not innovative. Well, having someone to help you with your books or be kind of that outside eye to take a look at what's going on may help you say, hey, did you think about offering this or that, or what have you? Something new, something different. So now the big question is, are you ready to face what you don't know or you don't understand? And that's basically where we're going to go into the different things that kind of will help you understand basics on the financials. I wanted to start with, and I know most of you know me, but giving you a little idea of where I come from and what I've done. I had my first company when I was 16 years old. It's when I started in business. So I've been in business for a long time. When I went to college, I discovered that accounting was my thing. Having been in business, once I got to school, I kind of discovered, gee, you know, I kind of like this stuff and I get it. I ended up getting a bachelor's in accounting, got my master's in business, and then got my CPA license, which I kept active for 4 years. And then after that, I did not keep it active, but I did go and sit and take the big test and pass the big tests and got licensed. And so I have that background behind me as well. My first controller position was 30 years ago. I can't believe it, but it was 30 years ago. And I have been at a controller position or higher in 15 different, some companies were a little bit the same, but most of them have been pretty diverse. So it gave me a lot of experiences of seeing many different ways to run operations and many different types of businesses I've been exposed to. So again, you're not dealing with a person who has done property accounting all their life or has done, you know, the same thing all the time in the same industry. I've been in many different industries, which gives me the advantage, particularly of saying, hey, okay, tell me about what you do and let's figure it out. And, you know, that leads to multiple accounting systems, operation systems. I've implemented a lot. I've looked at a lot of companies and made those transitions for the owners. And currently I own a company called Valid Solutions Consulting, which is an outsourced controller and CFO services company that provides for numerous companies. I do outsourced controller work, which cuts down the cost of somebody hiring, especially when you're first starting out, cuts down the cost of hiring your own controller or CFO. So with that, that was a little introduction for me, just to give you an idea of my background. And, you know, now it's why do you need to review these financials every month? So I kind of want to just give a, you know, and I know before I kind of said, why should you do accounting? This is your financials. One is cash flow management. Do you have enough money to pay all your bills, your employees? A terrible thing would be is if you're not getting bills out on time, you're delaying invoices, which means money's not coming in on time. You're not tracking who's paying you. Delaying vendor payments, of course, will affect your credit. So these are all important things why you should have an accounting system in place quickly. Sooner better than later. Having the separate bank accounts, having the separate accounting system to track this. So now the second reason why you should have an accounting system in place is tax obligations. Keeping track of your profitability is important. If you're profitable, you're going to owe taxes, and knowing how much you're going to owe at the end of the year or every quarter is so much more peace of mind. Being prepared for that is so much more peace of mind than saying, great, I had a wonderful year and I made $50,000. And guess what? I owe Uncle Sam X amount of dollars and you're not prepared. Well, you won't be prepared if at the end of the year, you're giving the CPA or whoever's preparing your taxes a box full of receipts and they come up with, this is how much money you made and this is how much money you owe, you won't be too happy. So,
Victoria, can I ask you a quick question?
Sure.
Years ago, I was working for a company. I was a contract person. It was just me, so I guess that was kind of my own business.
Right.
And I just, for taxes, I just set aside, it was either 25 or 30% a quarter, and I just would put that aside, and I knew that was it. if you, now that, but that was like as a contract worker. If it's my own business, and there's a whole other question, like not knowing about the LLCs and S corp and all that. Is it basically the same thing? Like you want to figure on putting a certain, like a certain percentage aside each quarter?
Yeah, many of my clients do what we do. We do quarterly estimated taxes. So the IRS has a system where they do quarterly payments. It's, you know, depending on where you are in the structure of your business, but it's recommended to do that. There are some penalties if there's, I think it's 80 or 90%. I think it's like 90%. If you don't meet 90% of the money that you should have had in, they will penalize you.
Okay.
It's not a huge penalty. Some people just like, okay, it's a small penalty. The IRS really penalizes you for failure to file. Okay, so if you don't file on time, if you don't file on April or March 15th for some corporations, so it's March 15th for some business, for personal and S corps, it's April 15th. You can also do the 6-month extension, but if you don't file, that's where the huge penalty comes in.
Yeah. Okay.
But the main thing that I'm saying is absolutely, if you start putting money away and you know, that's great. But a lot of people don't, you know, they just, again, they operate, I hate to say the kind of the shoebox or spreadsheet situation, and they're not really paying attention to, oh, gee, I should be putting some money away for taxes, because I've had that happen before with people. And they just, you know, they forget. And then, you know, you want to keep money in the company. Again, this was what I went back to what I was saying before about missing inventory and missing money based on, you know, who you have handling your financial transactions and or your inventory in your company. If it's just you, obviously not a big deal. But then again, you should really be doing what you're good at. You should let someone else. I mean, you'll hear this over and over again. It's not worth your time and your dollars. You're worth a certain amount of money to have someone else do your accounting for you, and you go do what you're good at. So, and I know there's certain thresholds to get that done, but I'm just giving you that idea. So this little graph I found the other day, kind of again does the same thing that we just discussed. Making sure you have controls, planning for future activities, complying with the law, you know, assist in decision makings if you want to expand or contract even. Maybe you're looking at your financials and say, hey, maybe I have to, I hate to do this, but I may have to lay off some people, or I may have to not use this service anymore, or any of those types of things. You really can't look at it and just look at a bunch of receipts and tell that. So having a financial statement is a much more effective way. So now we're going to go more into this is, I guess, one more: expansion, hiring, new products, system upgrades, things of that nature. So the first thing we're going to go into is we are really going to go look at these 3 financial statements. There's in the United States, there's primarily 3 financial statements that are looked at. There is a 4th one that deals with owners and changes in ownership and what have you. Most of the time you see that in a public company. Most small businesses, the reality is look at the income statement and the profit and loss statement and the balance sheet. But there is a cash flow, which I'm going to get to, and a lot of people kind of scoot over that and ignore it, but it's really almost the very most important financial statement. So just to give you an idea, I'm going to start with the income statement, which is also referred to as a profit and loss statement. It is a point in time. So when you see a financial statement, it is only for 1 year, and it is a point in time. So let's say it is December 31st that this is done, or the end of any month, July 31st. So it's like a snapshot in time of how you've done so far in this year. So this particular company, as you can see, had money come in of $500,000, and revenue can be made up of all kinds of different things. And future trainings that I'll have will go much deeper into these specific, the nitty gritty of these, because if I did that, we'd be here for 2 hours. So I've already tried that, and it's just your eyes will start glossing over. So it's easier for me to break these down into real small segments, this is just a brief overview. So that's money coming in. Then there's a cost, anything that's a direct cost to whatever you're making or selling. Some cases you may not have that. If you're in a services business, you may not have a direct cost. Most of the time, this isn't inventory related. If you're making something or buying something and selling something, you'll have a cost of goods. You would subtract that and you're going to get your gross profit. Those gross profit over the revenue comes up with a gross profit percentage. That gross profit percentage is, there's some industry standards you can look at and help you know whether or not you're making good money or not. I mean, in your industry, if you're making a gross profit of 15% in your industry and you're making that or more, you know you're doing well. If you're making less, then hey, maybe you're buying your stuff for too much money or not selling it for enough money. So that is kind of a little benchmark, gross profits. Okay. The rest of the expenses below the line are all the other operating, general and operating expenses that are necessary to run your company. Another thing you'll hear refer to quickly is the cost of goods are related to what you're selling. Okay, so it is a variable cost. If you sell X amount, you have to buy X amount to sell, right? So it's variable. These expenses below the line in this expenses area are generally fixed costs. Your rent is going to be the rent every month, no matter what. Your telephone bill is going to be the same. Your utilities are going to be the same. All of these expenses will be pretty much the same every month, no matter how good or bad the company does. So they call that a fixed cost. Once you get to that total operating cost, now you come to net income. Okay, net income is what's left, but it's not necessarily the cash that's left in the company. So a lot of people also do that. They say, oh, well, I brought in so much went out. Gee, this is my net income. And that really isn't true. And I'll show you why in the next slide. But while we're here, I want you to take note of this net income because all these financial statements hook together a certain way. And when you are looking at financials, it is very important for you to make sure that these numbers do what we call tie out to each other. Okay, it's the first thing I look at when I look at financials. So this 91,500, and I don't have them all being the same, unfortunately. One day I'll put them all together, but that net income is going to show up on the next financial statement that we're going to come to. So the next financial statement is our balance sheet. And I'm going to go right to, since we've been talking about net income, right to the place where that net income is going to show up. On your balance sheet, it's basically part of your equity. That number will show up right down here on your balance sheet. Now, depending on the software system you're using, because I've had this happen. Most software systems will break your net income right into this little area down here. Any of the net income from the years before will roll up into something called retained earnings or accumulated retained earnings. Those are all the prior years' net income that will be there. But when you're looking at a balance sheet and you're looking at an income statement, you want to make sure those two numbers are exactly the same. If they aren't, we've got a problem somewhere in the software or something's not right, but something's wrong if they don't equal, because it's a must. Okay. Now I'm going to explain how the balance sheet works a little bit and what it is. What does it tell you? Profit and loss, super simple, tells you money in, money out, what's left. Balance sheet's a little different. Balance sheet tells you the things that you own, the things that you owe for, and whatever is left over is your net worth, or what's, what you own after everything's paid for, or essentially your return on investment. So let's go over to the asset side. So the assets are anything like the money in your bank account, inventory, accounts receivable, prepaid expenses, which are things you pay for ahead of time, any fixed assets, which are properties that you, anything that you purchase for the company that is good. It's probably more than $2,500 and it's good for 3 to 5 years. or 3 to 20 years, depending on what it is you're purchasing, but you want that asset to be lasting for several years. It's may not even be a computer. If you buy a computer for $700, it's not worth putting it into computers on your balance sheet. But if you bought a whole office full of desks, you know, and you bought 10 desks and it was $10,000, then you would put that into a fixed asset. So it has to do with the materiality and the length of time that that asset does. And again, we'll go into more details when I get into the balance sheet section. Then there's other assets like goodwill when you buy or sell a company, but you end up with this and any investments, things of that nature. Investments, what I mean is on behalf of the company. And there are many other complex types of assets that can be here. That is on one side of your balance sheet. So think of it as a scale. So that's your total assets. And on the other side of the scale are the things you owe for. So you have accounts payable, which are any of your regular vendor bills, any credit card payments, any loans you may have, lines of credit, you know, anything that you'll owe for on the short term, under a year is in current, long term is over 12 months. Those things that you owe for. So let's say that you bought those tables and chairs or desk equipment, but you bought it on credit. Okay. So you've got the asset on this side, but then you're going to have the loan that you owe for that on the other side. And the only thing that you really own of those chairs and tables or whatever the difference is at the end of the day. Not to confuse things, but just remember that there's a payment and there's something that you owe for on the other side until it's all paid off. But we have to get that on your balance sheet because it's a liability. Then after that, if you come down, you get to your equity area. In order to start the company, you would have put some sort of money up. It could be $100, it could be $1,000, or if you have investors that come in with you, it could be a substantial amount of money. That may be capital that has been given to get the business going. Okay, that money is generally left in the company until the company is extinguished, or a partner leaves, or whatever else. The accumulated earnings and the net income, the accumulated, as we explained before, is year upon year upon year of the earnings, and your net income is your current earnings. Those earnings, depending on the structure of your company, can be taken in the form of owner's draws or dividends, or again, depending on how your company is structured. The liabilities and equity side have to equal the asset side. So essentially, like I was explaining to you, the desk, what's owed on the desk, the difference is really the equity that you have in that. All right, so that's your balance sheet. Now we're going to come to my favorite statement, which most people don't ever take a look at, and that's your cash flow. And the reason why cash flow is so important is because it really tells you at the end of the day what cash you have. So back on that balance sheet, there was, oh, and I meant to say, I know what I didn't tell you on the balance sheet is an accumulation of time. It still is on December 31st, but it's everything that's happened. So it's everything accumulated to that period of time. It's an as of date. So that's what your balance sheet shows you. Now, when we talked about the income statement and that bottom line number that starts off your cash flow, then you're going to have different types of activities which will increase or decrease. That's the cash in and out of your company. So I don't know if you remember looking at the balance sheet, you have accounts receivable and accounts payables. Well, the way that they get in there is the expenses on the income statement for you, but the actual payment hasn't been paid yet. So it's being held in either an asset or a liability on your balance sheet. And there's always going to be a difference of when they're going to get paid. So those have to be added and subtracted. And again, this is probably the most complicated to understand of all the financials, which is why I think people avoid them. But it is the most important one to show. So anything that's on your income statement shows up as a plus or minus in this area. And again, I would give more detailed information in another training. Then you're going to have money in and out from investments, which only show up on your balance sheet, not on that income statement. Okay, so when you pay for that fixed asset, it's not an expense. So let's say you pay outright for those tables and chairs and desks, $10,000. Doesn't show up that that money was spent on your profit and loss statement, but it does come out of your bank, comes out of your bank account and goes to your fixed asset. So you may have $10,000 that you spent, but it's not going to show up on that profit and loss. And then any loan principal payments, dividends paid, stocks issued will go in the financing area. At the end of the day, you're going to have a net difference. The ending cash balance will equal what your balance sheet cash amount is. And that net difference will tell you whether you have more money that you've spent from the month before or less money that you've spent from the month before. And again, this is a very complicated structure, so I would do a separate training on this, but I just want to give you an idea of what you're looking at. If you're looking at a cash flow statement, go right to this net difference, and then you'll be able to tell whether that company is spending more money or bringing in more money. Okay? I'm just going to tell you that easy. You can look at a public company and tell. Go pull up some public company cash flow statements, look at their cash flow, see what that number is. Okay, now, so what's next? Learning more detail about each one of these to see how it all fits together, because these are complicated, but it also gives you an idea that you can run back to your computer right now if you have accounting software, and you can look at those statements and have an idea of what you're looking at and how everything fits together. I will be doing a separate training on income statements, a separate training on balance sheets, and a separate training on cash flows, because I think there's a lot of intensity in each one of those, and I will spell things out very easily to understand. The next area that I think that also can be covered will be business entity structures. What's the best way? There's many different tax strategies with business entity structures and liability strategies. So it's not necessarily always the taxes. There's also some other things to consider as far as your liabilities are concerned. Looking at and giving you options for software, accounting software, including expense tracking software, being able to easily track expenses. There are numerous tax deductions you can take now that you're in business. I can do a whole separate training on that for sure, and maybe several, because even those tax deductions get very complex in some ways, especially when we're dealing with things like vehicles. There's a lot of detail behind vehicles of what you can deduct. How to hire, tax reporting. If you're depending on what state you're in, you may have different types of tax reporting. One state may be real easy and you only have 2 or 3 entities. Another one, you may have 4 or 5 entities that you have to report to, and different kinds of taxes when you're in business. My son lives in Hawaii, and I think there's like 5 different taxes we have to pay there in the state. So it can be a lot, depending on where you're at. Employees and contractors, how do you hire those people that work for you? What do you look for in a contractor? What should you have before that person even steps a foot onto your or works for you? Or if they're coming on your premises, what do you look for? How to hire employees, what do you need? What kind of documentation, what kind of insurance, all of that kind of stuff. And insurance, are you covered with all the different insurances that you need, depending on what business that you're in? All of those types of things are what an outsourced controller, outsourced CFO can help facilitate you learning about and guiding you in making sure that you've got your company structures and all that set up. Yep.
So since tax time's coming up, I am wondering if you could like potentially do tax deductions first in your series.
Yep, absolutely. Yeah, I did one back in December, right before the end of the year, which I can put up again. Okay. But yes, I would definitely tackle that first, because, well, it was either that or business entity structures, because I do have a lot of people who are looking for starting their businesses, and they're kind of asking me a lot of, well, what do I do? I mean, how do I start? So yeah, I may hit that one first and then start tax deductions after.
Yeah, well, if you have the video saved from the other one, that's fine.
Yep.
No, I don't mind looking at that right away too.
Okay. All right. Anybody else have questions, or it's my last of the screen, but I'll just stop sharing because and we'll just look at everybody.
Mhm,
Hey,
yeah.
Tess. Hey,
So,
Tessa. I see
um,
that you joined us late.
oh, there we go.
Yeah. Hi,
Hi.
thank you for
Tessa.
joining.
She's
Oh,
muted.
she's muted.
Okay,
Sorry,
There we go.
thank you. Yeah, no, I just had to put the boys to bed. So
that's fine.
thank
Hi,
you.
Tessa.
Yeah.
Okay. So does
Um,
anybody else have any questions?
No, that was good. That was a lot.
It's over. I know I'm trying to make it as simple as possible, but I'm
No,
also
it is.
trying
It's-
to let you be able to look, if you have QuickBooks or if you have something else that you are using, at least have an owner be able to go run over to their office or open up what they have and say, oh, now, like the light bulb go on it. Oh, now I understand what this is. And one of the things that happened to me was I was listening actually to Rachel Hollis in her, one of her books, I don't remember which one, but this is where I got the epiphany to do this. And she was talking about how embarrassed she was, even though she had gone to school, how embarrassed she was that she had these multi-million-dollar companies and didn't know how to read financial statements. I have been in this situation where I had the president of a company one time who actually pulled me in and goes, I hate to tell you this, but I don't know what I'm looking at. Because this wasn't something he did. I mean, he was a marketing guy and a sales guy, but he had never looked really in detail at financials and didn't know what he was looking at. So I'm trying to make it as simple as I can. It's a little bit complicated, but I think once I break down each financial statement, then I think it helps you understand where everything should go. And that just because the biggest fallacy I see is people think, oh, I have a profit and loss and it shows I have a profit, which means I have money. But it doesn't if you've leveraged yourself. If you have bought a lot of things and you owe for a lot of things, you're paying for that, but it's not showing up on your profit and loss.
So when you were talking about the different businesses that their percentages they make money, like I know how much veterinary hospitals should be making, and I know you know that.
Yeah.
And one of the things that I was wondering was, is there a master list someplace where you could find that, or do you just Google your business